Everybody, it's Tim Rhey with True Rate Mortgage Group. Here is your market update. Did you know that 22% of jobs postings that you see on the internet are actually ghost jobs? These are job postings that companies will post just to make it look like they're growing. Or maybe they'll do it to attract top talent or meet some legal requirements, but they have no intention of actually hiring 2%. Now, when you throw in the fact that there are remote job listings that companies post in multiple states to make it look like those are a lot of job openings, you see, the Fed uses the amount of job openings that are showing up as a signal for how well the economy is doing. Well, these reports may be a little overblown. And now that we know that 22% are actually not even real posts, this is the data that the Fed has been using to drive decisions on mortgage rate options. I'm not kidding. That is some of the data that they're using. They're also using inflation data. Now, on a brighter note, small businesses are reporting a more upbeat, optimistic viewpoint today. The NFIB Small Business Optimism Index jumped to 105.1 in December, and that's the highest point since October of 2018. Now, why do you think small business owners are suddenly optimistic? Well, small business owners are getting more hopeful about the economy with obvious expectations for growth. I mean, the economy's been a little rough over the last 4 years. I think we all agree on that. Business owners are hoping for lower inflation, and probably the biggest factor is the pro-business policies from the new administration that's boosting their confidence. Now, on to mortgage bonds. Mortgage bonds are what we look at to determine interest rates. And today is a pretty good day. So far, we're up 50 basis points. Finally, the market has not been good in the last 45 days. As we transition from the old administration to the new administration. Now we're up, like I said, about 50 basis points as of this morning. And the reason for that is the core CPI numbers just came in and it showed the year over year inflation had actually gone down. So a cooler inflationary report tells the Fed, hey, let's chill on the rate restrictions and maybe loosen up a little bit. So, ultimately, guys, it's a cat and mouse game of guessing whether we are heading towards a better jobs market or a worse one. And then on the other hand, is the economy heating up or is it cooling down? The Fed is trying to monitor all these things the best that they can using data that probably could use a little bit of updating, I guess. Now, from a personal standpoint, I think the inflation reports are pretty accurate, but clearly I think the jobs reports are a general disaster. And I think the data collectors need to fix these systems. When you talk about ghost jobs, and I don't know how you fix it, by the way, it's not my, I don't know if it's even possible to, but when you talk about ghost jobs and remote jobs that a company can post in 20 or 30 states, making it look like those are 30 new jobs, you can see how that's going to skew the data. This is the data, though, guys, ultimately that leads what interest rates you and I get on our purchases. Now, with that said, I want to talk about the present state of the union. Now, rates have not come down to where we had hoped them to come down, but I don't know that that is such a bad thing right now, and here is why. There's something called what I call the floodgate effect, and the question is, well, first of all, we know there are a lot of home buyers out there. The application data is telling us that. We know a lot of people are looking to buy houses, and they have been for the last 2 years, but they've been kind of waiting for rates to come down to get a better payment. We know that the floodgates are going to open at some point. Now, when the headline, when you start reading in the newspapers that mortgage rates reach 6%, I think that's going to create a little bit of a rush to the market, and which is totally fine. Just understand that when you wait for that rush, you are now competing with more buyers to get the same house. And that's completely fine if you're okay with that. Just understand that when you compete with other people for a home, you end up paying more and the seller ends up giving you less. Let me give you a good example. I've got two contracts that just came in recently, literally the last week, and both of these buyers understand that rates are not perfect right now. However, the home that they wanted to buy, there were no offers for 70 days, 60, 70, 80 days on these homes. So the seller is, dare I say, desperate, eager, willing. I'm not sure. But when you have a home that's been sitting on the market for a while, usually the seller is willing to hear what you have to say in your offer. So, long story short, these borrowers of mine that are working with fantastic real estate agents made an offer on these homes and asked for money from the seller concession money to buy the rate down for the first 2 years. So they're getting a rate that's equivalent to where rates were 2.5 years ago. Not 2%, not 6%, but they're getting a rate somewhere in that range for 2 years. Now you ask yourself, well, what happens after the 2 years? Well, at that point, the rate just would lock in at where rates are today. However, these borrowers understand that rates are going to come down and they are going to have an opportunity to refinance. They're hedging that bet, actually. So the good news is with those temporary rate buydowns that these particular buyers are taking advantage of, once they refinance in a year or anytime before that 2 years is up, they get the money back that was in that account for that 2-1 buydown. So long story short, sellers are willing, usually, I say usually, not all, most sellers are a little bit more willing to accept your offer and even maybe give you some money to help make the deal happen today versus what happens when the floodgates open at the, I say 6%, it could be a little higher, it could be a little lower, but there's going to be a floodgate number. And when it happens, just be ready. And if you are okay competing and if you are okay paying a little bit more money for a home, then just wait and be patient if that's your decision. I'm just telling you, be ready for the competition. Now, I personally bought an investment property 3 years ago when rates were historically low, and I ended up competing with 25 people. I ended up winning the offer because, that's what I do, right? I win offers. No, I ended up paying $20,000 more than the home was worth, and I had to pay that out of pocket. If you remember, we had this thing called the appraisal gaps. Those are going to come back the minute we hit our somewhere around that floodgate, I think. So just be ready to pay a little more and compete a little harder, and that's what's going to happen here. So if you're on the fence, you're looking to buy, or if you want to talk about anything we talked about today, from the BLS report to the JOLTS report to the inflationary data, projections, predictions, you name it, happy to help out. We are always available for any question on any level to help you out. Have a wonderful, wonderful day.